you aren't getting buying ahead of the tariffs. So you could have it could disguise a recession for a little bit longer. But I think before we get to the end of this quarter, it'll be clear that we're in recession if we're not already now. So the Fed can, again, talk about we're comfortable with our policy. We can go either way. We think we need to stay, they are restricted, need to stay with where we're at until it's clear what the tariffs do. You're missing it because, man, we are in a recession probably now, and we are seeing inflation go down, not up. So you're going to look like fools like you did in 2022 when you waited too long and you were so sure you could take your time because you're looking at backward-looking data. You have to be able to put pieces of information together, and that's why I can forecast. These guys, their dot plots and things are all based on data that's already come in. So, looking backwards.
You can feel it. I mean, you just have to look around.
Well, that means there's going to be a moment within I think it could be May, but certainly by June or July, be generous saying July, there's going to be a moment where even the Fed will say, oh my goodness, we can't just sit on our hands anymore. We've got to ease. Now, will they ease dramatically or will they do it a quarter at a time initially and then realize they've got to catch up? I don't know. But all these people will say, oh, there's probably no rate cuts coming for several months or maybe even only one or two left in the year. They're not doing a very good job of forecasting because this economy is slowing.
So your updated thesis, if I'm correct, is that, the catalyst for the bust could very well be the tariffs and the trade wars that develop over the next 3, 6, 9 months. But before that, the Fed's going to wake up, see that we're in recession, slash rates. It's going to look like things are kind of getting sorted out on the trade war side where people are coming to the table. Some deals will get done. That's going to fuel the final melt-up phase?
Yeah, I think so. For sure, the deals will be supportive. Secondly, I think it's the fact that, well, I'll get back to your Treasury comments before, because I don't agree with the fact that our debt situation is going to be a big story in the next few months. I think rates are heading lower. I've been saying for a while now that I would not be surprised to see sub 3% by this summer and maybe even 2.5% on the 10-year. That's a big drop, from where we are. And everybody else has been looking the other way because of that bounce in rates.
David, that is literally the most important thing that we need to talk about, because getting to 2.25%, 2.5% on the 10-year would get the U.S. out of the biggest bind that they've ever been in. You know as well as anybody that $9 trillion is maturing, right? This year has to be refinanced. Already 2.5 has been matured. The average on that debt is already about 3.2. On all the U.S. Treasury debt is about 3.2, which is the highest in 15 years. The whole game is getting that 10-year down, right? That's the back end. The Fed can cut all at once. How in the world are they going to get the back end, the rest of these countries, to go along with the 10-year at 2.5 or 2.25?
First of all, and I have not, when the rates went to 4.55 last week, and people were panicking, ready to jump out of their 10th floor apartment building, back up and take a little perspective, because back in early March, I said you can see a head and shoulder top in rates. There's a right shoulder at 450, and there's a gap that we gap down from 440. So there's a gap to be filled at 440. So I said between 440 and 450 is where I'd expect rates, and this is when rates were down at 4.25. They went back from 4.25 back in March to 438, I think was what I saw. And then somebody said overnight it had gone to 440, so it filled the gap overnight. Then they rallied, rates went down first to 19 or something, then all the way down to 4% or just below.
Oh yeah, we got below. We got below the 4 handle during this big sell-off, yeah.
And then we had that big run up to 455 or 457. I said, it's just a round trip to where we were 2 weeks ago or whatever. And yet people are forgetting that we came down from there and acting like this is a big new run. So I was not worried about it at 455. If you remember, that same day it got to 457 or whatever, it was down below 450 again and maybe 445 that same day. So it wasn't up to very long. And every story came out. They're selling their bonds to play hardball with Trump, and you had every bearish story coming out about rates going up. We're going to 5. I heard 6. We're going to 6. And I said, I'm sticking with my view. We're going to 2.5. And ultimately in the bust, as you probably know, I've been saying we'll see a 0 10-year. But what you also have to remember about that, the refinancing, a lot of that is T-bills. I mean, the number is huge. If it was all had to be 10 and 20 and 30-year bonds, that wouldn't get done without rates going up. And don't forget, I think the odds are that during that period, the Fed's going to be easing, not just cutting rates, but probably will be in recession deep enough that they'll finally say, we got to expand the balance sheet again. We got to be doing some QE. So,
yeah, I think it was so startling for people because, typically in my lifetime, when the markets are crashing in that way, you're seeing, rates go down, and that wasn't happening. So you had the dollar falling with the U.S. equities, and it was like, whoa, gold was the only thing going up.
But again, I've done this a long time. I know how the traders react, and I know how the narratives get. They take the ball and run with them. So I was pretty comfortable, surprisingly comfortable, given the panic that was out there. I mean, you had reason to say we're breaking all kinds of technical levels on the stock market. This thing. And yet I didn't flinch at all. Like I said, it's my target because I saw pretty clearly this was an emotional sell-off. People were adding 2 and 2 and getting 8. The bearish story, the narrative just, they take the ball right with it.
So you don't think, there's two things at play here, right? Like the Fed can ultimately become the buyer of last resort and just start buying everything, but then that has problems of its own. But you don't think the debt, 37 trillion heading to 40 trillion in a hurry, is going to dissuade countries like China, Japan, whomever from participating and stepping up at these auctions and buying our debt?
Yeah, don't forget, we are still, as much as people want to dismiss the U.S. and say the dollar's losing its reserve status, or the rest of the world doesn't see us the way we see ourselves, or what have you, or Trump's alienating our trading partners, what have you, they don't have a lot of alternatives. Where are you going to go and feel safer? We still have a system that most people say is the most trustworthy, backed by the most stable policy. Even if you have views that I don't have about Trump, even if you do, you still look and say this is still a country that's come through. Hey, we came through 4 years with a president that wasn't even aware of what was going on. So, I think this is a step up no matter what you think of Trump.
That's true.
All joking aside, it really is a case where the dollar, both the dollar and the U.S. Treasury, is something they can't just walk away from, particularly with the balance of trade issues. China has to put their money somewhere. There's exchange issues there. If you're selling so many goods for dollars, you got to do something with those dollars. So it's not wholesale. People at the margin, things can happen at the margin. They could lighten up on their treasuries at the margin. Other countries could lighten up on their treasuries. Wall Street tends to be all in or all out. They're bailing out of the treasuries. They don't want our treasuries. So I'm not worried about that. Secondly, and I've had this view for a number of years, I've said when we get to the bust, part of the reason we're going to get to a bust is because the Fed's attitude right now is going to be carried forward. They'll ease, I think, this quarter, but they're going to be behind 8 ball for a while into this recession and ultimately into the bust, because Powell has etched in his mind, I want to be Volcker. I don't want to do what Bernanke did. He said it over and over. We're not going to blow up the money supply again to bail out Wall Street. So all through a time when we're going to be in a, like I said, potentially the biggest financial crisis in history, meaning bigger than 2008-9, and the biggest central bank in the world that does most, they all do it. At the time when you're going to need liquidity more than you ever needed it, Powell's going to be, I'm the Volcker here, I'm going to be the disciplined guy, and we're not going to do that again. I promised you I wouldn't do that. They will do it. I guarantee you that the easiest prediction I can make is that the balance sheet could blow up to 30 trillion. Or more in response to a free-falling financial system, because they waited so long, because they kept thinking, as long as we stay the course, it'll right itself. And then all of a sudden they see banks failing across the world. And it's not just Powell or not just the Fed. It's the ECB, it's the Bank of Japan, it's the Bank of Canada, it's probably China. They're all going to be sitting on their hands to some, or at least easing a lot less than they did in 2008-9 initially, thinking, we made that mistake, we don't want to make it again. And then it's when the deer in the headlights moment comes where they go, oh my God, we can't worry about that. We got to save the system. Then you're going to get money after money after money. So I've never been worried about who's going to buy our debt. I can guarantee you that the Fed's going to buy every single debt instrument they can find, U.S. debt instrument they can find, if they're trying to get 20 trillion into the system. Don't mistake what I'm saying. I'm not saying they're going to go from 0 to 20. They'll put a couple trillion in and say, that's it. And then sit on their hand, and a month later, nothing's changed, going down. And then another 3 or 4 trillion. That's it. It'll take them several months to get to a point where they say, we just got to do whatever we have to do to save the system. We're going to be the buyer of last resort for at least the next 12 months for sure.
So US dollar short term, you still see it going down, low 80s on the index, but during the bust, you're expecting it to soar.
Yeah, I think between now and the bust happen by the end of the year, the dollar can continue to go down early in the bust. Because, as I said, they'll be easing. So there'll be some concern that, gee, we're doing it again, even though it's not nearly what we should be doing or what we did last time. There will still be plenty of people on Wall Street saying we shouldn't be doing this, and he's putting more dollars out into the system. He's printing more dollars. And it'll keep pressure on the dollar into the early part of the bust, is my guess. But there comes a point, there's a crossover point in the bust where the whole world says there's only one place we go if we get this scared. It's the U.S. So I think probably within the first quarter of the bust, or first third of the bust, certainly, you'll begin to see the dollar get bid up again. I think you could go from 82, assuming that's the number, back to 120.